Okay, here's a quick refresher for the introductory topics for MBA 523. So these are topics you must have seen in 520, but some of you may have taken 520 a while back. So I thought it might not be a bad idea to, give you this quick refresher. If you're comfortable with all the introductory topics, you can safely skip this. All right. So let's first start off with the time value of money. So what is time value of money? So we know that a dollar, if you have it today, and today is what we'll call the present time, so that will be the present value or PV. So if you have a dollar today, it's worth more than if you have it tomorrow, which is a future value because it's a value in the future. Why is it worth more today than having it tomorrow? The reason is if you have the money today, you can invest it for some time period and you can earn some kind of a return R. And this is basically what is time value of money. The fact that if you have money today, you can invest it, you can get a return, and you hope that it's going to be worth $1 plus 1 plus R if you're investing a dollar. And the hope is that that's going to be more than a dollar since we expect the return to be positive. Now, the cash flows can be a single period cash flow. For example, it can just happen once. Let us say a $20 cash flow 2 years from now. It can be a multi-period cash flow, but it might be irregular in amounts. So, for example, you could get $10 in time one, $20 in time two, $16 in time three. Or it can be a multi-period cash flow pattern with regular cash flows. That means the amount that you get is kind of similar every time period. So you could get $20 every period for 3 years. So that will be a 3-period annuity. So an annuity means these cash flows are the same and they occur for a preset time period. So they will end at some point of time. Or you can have perpetual cash flows. These are cash flows that do not end. So you get the same amount of cash flow every period forever. So that's a constant perpetuity. Or you can have a growing perpetuity where the dollar amount grows at a constant percentage rate every year or every period forever. So these are all the different cash flow patterns. Now the convention in finance is that all the cash flows are going to occur at the end of the period unless it is stated otherwise. The current time period, let us suppose we call that 0. So anything that we say is at year 1 cash flow, that is going to occur at the end of year 1. So that means 12 months from today. On the other hand, if we say that the cash flows are going to happen at the start of every time period, then a time 1 cash flow will happen at the start of time 1, which is today. Okay? So drawing a timeline actually helps. So I have this timeline here. So this is your timeline. I'm going to put the time periods here on top of the line, the cash flows at the bottom. So my time period 0, that is now. So that will be whatever value there will be your present value. And then I have 3 time periods, 1, 2, and 3. And these are all future values. Now keep in mind the actual time year 1 is going to be this time period here. Okay, between 0 and 1. So these are the 12 months that occur in year 1. So this is going to be the start of that year 1. So that's going to be a time 0. This will be the end of year 1. So this will be time 1. Okay, and then time 2, time 3. So this irregular cash flow that we saw, 10, 20, and 16, you can plot them on a timeline like this. Now the reason why this is highly encouraged is because it makes your calculations in a very visible way, so you're able to see when the cash flows occur, and if there's something that looks incorrect, you can check it. All right, so this is a very good visual representation of cash flows. Now we said here that you hope to get a return R, and the hope is that it's going to be a positive return. Okay. So what we are saying is when investors make investments, they expect the investments to make money. So if you think as an investor that a particular investment is going to lose money, that means you are expecting a negative R, then no investor is ever going to invest in it, right? Because why would you do that and lose money if you think that doing that is going to make you less money, right? Why is that? The reason is if you do not invest, you expect to have $1 as opposed to expecting to have less than $1, because if you're losing money, you're going to have less than $1. So this is the first principle of investor behavior. Investors prefer more money to less. Okay, and this is like the non-satiation principle you see in microeconomics. That means whatever be your state of life, how much ever billions you have, you always prefer more money to less. Okay, all else equal. Okay, so people always prefer more money to less. So we expect this R to be positive. So no one will invest if they expect to lose money. Okay. Now, when we say we are expecting to earn a return R, what this means is we don't know for sure that you are going to get this return R. So, for example, if we say I expect to earn a return of 10%, that means I'm not sure that I will get 10%. I expect to get 10, but there's no guarantee. And that is because of risk. So other than a risk-free asset, examples are US Treasuries or insured bank deposits, investing in pretty much any other asset can be considered a risky investment. Why are they considered as risky investments? The reason is because we don't know what the exact return is going to be that we can get from that investment. It can be more than you expect. It can also be less than you expect. Okay, so this is basically what is a risky investment. So you don't know the exact return for sure, but you expect to make money. You expect the return to be positive. Now, as an investor, if you want to get away from risk, so let us say you say, hey, you know what, I don't want to have any risk, then the only way to get away from all risk is to make an investment in a risk-free asset. Otherwise, all the other investments are going to be risky. Now, we've been talking of risk. So what are the different types of risk? So in finance, we'll typically classify risks into two types. The first is what is called the diversifiable risks. These are also called unique risks. That means they are unique to one firm or a few firms or a couple of industries, okay? As opposed to systematic risk or non-diversifiable risks. So the diversifiable risk, that is something that we can eliminate or minimize, get away from it. How? By holding a diversified portfolio of assets. Now, the systematic risk or the non-diversifiable risk or the market risk, that is something that you cannot eliminate. So if you do not, as I said before, if you do not want to have any exposure to this market risk or systematic risk, the only way is to go ahead and hold a risk-free portfolio. So how does this diversification work? How does it help reduce the risk? So let us consider one of the possible sources of risk as a change in prices of aircraft fuel. So let us say the fuel prices go up. Now that's a revenue item for oil companies. They sell oil. The price of what they're selling is going up. So what happens? Their profits are going to go up because their revenue is going up. Their profits are going up. What happened to the stock price? It will go up. Now, on the other hand, you have an airline stock where aircraft fuel is an input into their production process. So what happens when the price of aircraft fuel goes up? Their costs are going up, so their profits will come down, and therefore they're making less money. Their stocks are going to be less valuable. So you hold a portfolio with both oil stocks and airline stocks. What's going to happen? The increases here are going to be offset by the decreases here. These offsetting effects are going to make sure that this impact on the portfolio is not going to be very big. As an alternative example, we can think of, for example, Microsoft and Amazon, and both are competing, let us say, for cloud services. Okay, so let us suppose that Microsoft cloud service, they don't come out with a new product. Amazon comes up with a new product. Okay, so more companies are going to use Amazon Web Services. Fewer companies will be using Microsoft services. So what's going to happen? The price of Amazon stock will go up. The price of Microsoft stocks will go down, and this increase and decrease will offset each other, and thereby minimize the impact on your portfolio return. So this is basically how diversification works. Something that happens in one part of the portfolio, its effect is going to be offset by something that happens in another part of your portfolio, and because of this offsetting effect, you are able to reduce or eliminate these diversifiable or unsystematic risk. Okay, so that is basically what is diversification and how it works to reduce risk. Now, we said that the risk that you cannot eliminate is the systematic risk. That is something you cannot eliminate. The diversifiable risk, you can eliminate it. So in asset prices, this diversifiable risk will not be priced. It's only the systematic or market risk that's going to be priced. So how do we measure this systematic or market risk? We usually measure it using beta. How do I convert that measure of risk to expected return? We can use the CAPM, which you've seen in 520. So you can use the CAPM to estimate the required rate of return that investors expect for holding an asset with a particular level of risk, a particular level of beta. So this is the equation for your CAPM. Expected return equals risk-free rate plus beta times this whole thing in parentheses. That's a market risk premium. Now convention, a risk-free asset has no risk. That means beta should be 0. The convention is for the market portfolio, the beta is 1. Okay, so if you have a very risky asset, its beta will be more than 1. You have a less risky asset, its beta will be less than 1. So this is a quick overview of what is time value of money, what is the expected rate of return, what is risk, what are the different types of risk and how diversification works, and how can we convert this non-diversifiable or systematic risk, which is beta, how can we convert that into an expected rate of return, and that is using the CAPM. So what we'll do next is go ahead and look at a few problems on each of these topics.